It's Monday and it's right afternoon, so it is time for our Monday market update. Jennifer Tim, I'm the Welcome Home Global Group powered by Keller Williams, and every Monday we empower you with some information about what's going on in the real estate market so that you can make informed decisions about your real estate. And of course, we're always here to guide you. So let me get started. And as I share my screen, I just want to apologize. I do have a bit of a cold, so I will do my best to survive this and try and get through quickly and briefly before my voice gives out again. So February 6th, can you believe we're in February? Well, a new month and some new information, and I'm so excited to share this with you today. So our question for today: are more properties coming onto the market? So traditionally, this is when we start seeing that uptick of sellers who are willing to put their homes on the market. So what is happening, and are we seeing that trend? So we're going to look nationally, we're going to look at some information, we're going to look at some of the economic factors that have influenced where we are today, and then we'll have a look at Southern California and then drill down into some of our local cities. So let's get right to the national news. Well, big news last week is that the Feds increased the rate by 0.25 points. So we're now sitting at 4.75. And as you can see, these lines over here are sort of those recession lines. So we're kind of at that point, and it's a little, well, we were anticipating the quarter point increase. So let's see how the market has responded to that. So this was not a surprise last week. So let's get a little more information on what happened. So as expected, the rate was increased by the 25 basis points, and it's the highest level since October 2007. Now, this is what's significant. So during his press conference, Chair Powell remained firmly committed to fighting inflation, explaining that the tight labor market would keep upward pressure on wages and prices. However, he later suggested that a couple more rate hikes would probably get to the appropriately restrictive level necessary to bring down inflation. Now, having said that, I heard something on the news this morning that there may be a reversal of that decision, but I haven't heard anything since first thing this morning, and we will definitely let you know next week what direction, if we know, Chairman Powell is headed with that one. The other news that came out last week is the jobs report, which shows an increase of 517,000 jobs in January. And this is a lot more than was expected, which was the 187,000. Unemployment rate fell to 3.4%, whereas the estimate was 3.6%, which is the lowest jobless level since May 1969. Leisure and hospitality added 128,000 jobs. Other significant gainers were professional and business services, government, and healthcare. Now, why is this significant when we're talking about housing? Well, when people have jobs, they can typically afford to pay for a mortgage. And that's why we always have a look at these factors and see how that is going to influence where we're headed for the year. So from a housing point of view, this was a great report to see. Other thing that I didn't add in here is that these wages have actually gone up a little bit as well. So again, the buying potential for buyers is there. So let's keep looking. So the consumer price index and the headline and core year over year since 2000, well, you can see that we really reached those peaks. That was what the Feds were so concerned about, because the higher you go, that's when we end up in a recession, as we saw from the very first slide. So seeing things come down means that what the Feds have been doing is having the desired result, which is to reduce their consumer price index. Now, what's really important for us, excuse me, is the 10-year Treasury, because this is really what goes hand in hand in hand with interest rates. When this goes up, we start seeing that the interest rates go up for mortgages. So what are we seeing here? We definitely have seen a decrease, and now we're sitting at this point right over here. So 10-year Treasury is not going up at the same rate as what the feds are doing. So this is then translating into what we saw, which was interest rates that actually went below 6%. Last week. The last time we were there was November 2008. Now, this is really, really good news. So remember that in October of 2022, so just a couple of months ago, we peaked at 7.37%. We've been slowly decreasing, as you can see over here, we've been slowly decreasing in January, and to reach that milestone of going below 6% is such good news for buyers. Now, it's also good news for sellers, and we'll talk a little more about that when we look at Southern California and what we're seeing with our inventory and our buyer demand. So back to what the national picture is looking. So this is an article from Realtor.com. So we've got January marked a whopping 65% more real estate listings than the same month a year earlier, according to a recent inventory report from Realtor.com. And while home prices are still up year over year, they've declined from the pandemic peak. So January's median list home price clocked in at $400,000, which is steady with December, but much lower than June's record high of $449,000. Now, again, these are national numbers, so they're definitely not Southern California. In addition to this deluge of homes for sale at more reasonable prices, mortgage rates are also down from their 20-year high, which broke 7% in November. For the week ending January 26, Freddie Mac found that the rates for a 30-year fixed rate loan averaged a mere 6.13%. So we saw them drop down below 3. They popped up a little bit, but that downward, very slow downward momentum is there. So these three things, lower mortgage rates, stabilizing home prices, because again, who could afford the crazy, crazy increases in prices we've seen in the last couple of years, and the glut of listings. Well, that's a little, I think, a little over ambitious, the glut of listings, spell a long overdue opportunity for home buyers to jump into the market and snag a deal. So nationally, yes, listings are starting to come onto the market. And buyers are responding to the lower interest rates, because now it comes down to affordability. Buyers are feeling like they can manage to pay a mortgage, and they are getting back into that home buying trend. Thank goodness for water when the throat is like this. So just going back to some of our numbers. Available single family homes for sale. As you can see, when we look, we can see a tiny, tiny little increase there. So we are starting to see an increase, but we are way, way lower than where we were before we started before we ended up in the pandemic with COVID. So that is still a factor today. And that is why those home prices are not going to be plummeting, because we are so below where our comfortable, boring, and balanced market should be. But it is good to see that properties are coming on the market. Pending contracts per week, we know that the demand is strengthening, which is a good thing. So the light pink is the new pending count for single family, and then the burgundy is the existing pendings. So we know that this demand is increasing. So last week we reported that mortgage applications were up. I think it was 25%. Those are now translating into new escrows. So that means that buyers are back talking to their lenders. They're getting pre-approved. They're getting back in the market, and they're actually finding what they're looking for and writing up offers. Offers are being accepted, and they are now going into escrow. Demand and the mortgage rate. So you can see as the mortgage rate comes down, and this is like that 6%, but as we said, it dropped below the 6%. It really depends, on your local providers, what they're able to offer. And we'll look at some of our Southern California lenders and what they're offering right now. But this is the significant one. Look at that jump in the purchase demand. So this light gray in the background is the purchase demand. So this is the good news for sellers out there. So sellers, the buyers are back. They need more inventory. They're not finding as many homes on the market as they need and what they were used to back in pre-pandemic era. And that still remains our biggest challenge. December pending home sales. This is an interesting, just kind of by region to see. And yeah, the West, we're up month over month. The South is up. Northeast is up, surprising for the colder region. Midwest tends to be that, they're all snowed in and iced in and nobody wants to do anything. But we're starting to see these increases coming in, and that means the buyers are back. Absolutely good news. Price reductions. So here's the burgundy line. This is for 2023, steep decline in price reduction. So what that means is properties that are coming onto the market, providing that sellers have heeded the advice of their agents and are pricing ahead of the market, are actually pricing correctly. Buyers are finding those prices acceptable. They're not having to go through price reductions. They're not lingering on the market, and those properties are going into escrow. So the speed of decline is definitely a lot faster than some of the experts out there with their crystal balls had expected. So our decreases in prices are really getting closer to what we normally see, where there are always some sellers who are a little over enthusiastic about their prices because they believe the best strategy is to build in that negotiation buffer, which actually tends to count against them. Properties with price increases. So this is going to be an interesting one. So what we saw at the end of last year is when those interest rates went super high, when those buyers pulled back because it was all about affordability, many of the home sellers said, well, oh, hold on a minute, let me pull my property off the market. And especially if they'd gone through a couple of price reductions, because remember, there was a pretty significant steep increase in interest rates that we saw from June to November, where, we had started the year at 3-point-something%, ended up at 7-point-something%. And a lot of those buyers just ran for the hills. It was just not going to happen. Sellers who had their properties on the market, especially round about that summer timeframe, who had seen their neighbors selling for 100, 200,000 more for properties in Southern California, not in other areas necessarily. Those sellers had to do a number of price reductions. As soon as you start that and their properties were languishing on the market, then a lot of the sellers opted to pull them off the market. Well, guess what? They're now coming back. And what they're doing is they are pricing ahead of the market because they're looking at, remember last week we shared that overall since 2009, nationally, we've all seen a 29% appreciation in home values. So they've been able to reassess where the market is currently. And we are starting to see that some of those properties that went through those dramatic price reductions, still didn't sell, pulled off the market, are now able to come back. And they're at a higher price than where they were before they pulled them off the market at the end of last year. So normal is 3% in price increases, and we're going up pretty quickly. We're probably going to get back to that average pretty soon. So specifically, what is happening in Southern California? So as I said, it is so important to look at your local providers, your local mortgage experts, to see what the rates are currently. And so Wells Fargo is one of our lenders that our buyers tend to choose. And their jumbo 30-year fix, the interest rate is 5%, your APR is 5.1, and that's for just under a 1 discount point. So those are pretty good rates. This means that a lot more buyers are now, they're already pre-approved and they are out there shopping. The challenge is going to be the inventory. This is another one of our lenders, so they're a little higher, but again, it's actually under the 6%, and it's been that way for a couple of weeks already. So in Southern California, the buyers are back. So now we've got to look at, what's happening with our inventory and our demand and what the biggest challenges are for us. So we are so lucky to have Stephen Thomas, and his company is the Reports on Housing, and he does a housing debrief with us. This was from Thursday last week. And I just want to share what he's seeing. And basically, it is that we have a housing bounce. And this is the good news again. This is what we were waiting for, is to see how the market was going to respond to the conditions in January. And so much of that sets the tone for the rest of the year. Our biggest challenge is going to remain our active listing inventory. So as you can tell, if we go back, and let's go back to, even like going into 2019. I mean, this is really, we need to be a lot higher than we are. I mean, we're sitting right over here at the moment with our inventory. We did see a little peak last year, and, that latent, those properties that were on the market are going so fast, and we are now really, really low, and we need to be hitting a lot higher in order to meet our demand. So let's have a look at that listing inventory year over year. So today we are sitting at 21,000. So this is for Orange County as a whole. And as I say, this data was from Thursday last week. So 21,639 homes on the market for sale. Last year we had 12,000. So that was this orange line. So we were super low last year. And part of that was because, that low interest rate we had, so the threes that we were sitting in, that was the world we were in at the beginning of 2022. Those properties were just flying off the market. Some of them didn't even hit the market before they had multiple offers and were sold. So our 3-year average is what we really need to look at, because of course, COVID introduced some very unique market conditions. But our 3-year average is 33,000 or 33,500. So we are below that level. And our problem and our concern right now is this trend. This is the variance that we're looking at, that we just short so many homes on the market. The main reason for that being that many sellers have low interest rates. So they refinanced during COVID, all that was offered. And, we're sitting, personally in our family, we're sitting in this 29% who have a super low rate, and there's 89% of Californians who have a current interest rate of 5% or lower. So what happens? So this is the big dynamic. Sellers are not going to sell or not feel that motivation to sell until they're sure that when they sell and have to take out that next mortgage, they're not going to then end up with an unaffordable mortgage payment. So as we get into the 5 range, this is when sellers are going to feel, okay, well, I can sell my home because, I can go a little higher in my interest rate. Because property values are still doing great in California. So it's still a great investment, and I can afford, because affordability is everything, I can afford to pay in the 5s. The 6s were that little shining ray of light for many sellers and buyers, because of course sellers become buyers for the most part. Buyers are buyers. So, those sellers become part of our buyer market. So this is the whole reason why we've got such an inventory shortage, just because so many home owners put a lot of investment into their properties during COVID. They refinanced, got that low mortgage payment, and didn't want to move. Well, now what we're starting to find that sellers are starting to ask us, how much could I get for my home realistically? And once they realize that the craziness, the unsustainable, insanely hot market that we were in is gone. It is a thing of the past, because that was the 3% or lower interest rates, and we're not there anymore, and we will not be going back there. heaven forbid, unless there's some major global catastrophe. So now they're getting used to this idea of, okay, we're getting back to a more reasonable interest rate. And again, I say this every week, historically, through recorded history, our average interest rate has been 7%. So 6% is good. 5% is so much better. And that's what's starting to motivate sellers to put their homes on the market and then become the buyers so they can find their next property. And of course, this is what our buyers have been looking for. So our new listings monthly, this is kind of what we normally see in the trend. So we normally see more properties coming onto the market, with the exception of 2020 when COVID hit and the, basically real estate just came to a grinding halt for a period of time because we couldn't do anything. But then it recovered. And as you can see, we normally see new listings coming on in our spring market, and then they go into escrow and everything tapers off down to our holiday and our winter market. So we're now in the winter market and getting towards our spring market. And so the big thing is to see and predict, where are we going? Because we need more homes on the market to meet the buyer demand. So 3-year average pre-COVID, this gives us an idea of where we are and where we are currently. So we are definitely a lot lower than where we should be. So I think we've beaten that dead horse. And here's another version. So where do we think we're going to go this year? So Stephen Thomas, looking at all the data, and he's been tracking for, I believe it is 3 decades already, is predicting that we are going to see an increase. That is a little optimistic. He thinks that we're going to be a little more tempered and probably see something just below our 2022 listings. So does it mean that we are going to see some more homes on the market? Yes. Are we going to see enough to meet our buyers' needs? Probably not, and especially if the interest rates keep dropping as they seem to be doing at the moment, which again is great news for sellers and buyers. So talking of that demand, so the demand is the number of properties that are going into escrow. Well, let's have a look. Traditionally, this is what we see at this time of the year. We see that once the holidays are over, then that is when buyers get back in, put those, get back in the car again, start looking at properties, get those offers going, and that's what kicks off our market. Well, we have definitely seen a sharp increase in the number of pending. So we're up 31%. 3-year average is higher, of course, but that's because there were more properties. But this is what we're seeing. So this is telling us that buyers are okay with the interest rates, and they're getting more and more encouraged as they see the interest rates going down. So the buyers are back. The buyers are back. I mean, bottom line, the buyers are back, but they need some properties. Now, where are we going to go year over year? The prediction is that we are going to go up. And again, it's going to very much depend on the interest rates, but we're still seeing, we've had some really funky times where we've had some strange peaks in our market, but this is going to look more like that typical market where that spring market inventory comes on. We're going to see our buyers putting offers in on properties run about this period and going into escrow. And then as we go into summer, when everyone wants to be, they want to get that moving done early and then get everyone settled, and especially if there's kids involved, the families want kids settled into their new environments so they're ready to enter school in the fall. So this is the prediction. And the demand is there. It's just, we've got to keep an eye on those interest rates. Not every buyer is going to be back in the market, but they're enough to definitely create a shortage in what's available. So multiple offers, we're already starting to see them, and buyers have got to be on their game. But sellers this year, this is when you're going to have to be more realistic, because the buyers, they've been burnt. Many of them have been in the market, lost out, pulled back, waited for something a little more affordable, and they're back. expected market time. So this is the number of days on market before, so from the time that the property is marketed to the time that it enters into escrow. And you can see that we are kind of at this point. This gives you an idea of what determines a seller's market or a balanced market. So that balanced market is 90 to 120 days on the market. 60 to 90 is a seller's market. 120 to 150 days, we don't even know what that is. We don't. It's been a while since we have been in that type of environment. So let's see where we are. Well, in just over a week's period from when we had our previous report from Stephen Thomas to the one, so actually it was just over a week, we dropped 25 days on market. We were sitting at about 83, 84 days on the market, and we're now down to 68 days on the market. So what is that telling us? This is telling us again that the buyers are back, that as soon as the properties are coming on, they're getting out there, they are pre-approved, and they are shopping, and they are going into escrow. So, 80 something days is almost 3 months. Now we're talking about, just over 2 months. That's a big difference for properties on the market, because the faster it sells, that proves that price is at, that list price is what the buyers are willing to pay for. And last week we looked and we saw that for the most part in Southern California, properties that sold price is 98% of list price. So it's pretty close. And in some communities, it's actually sitting at 100%. Haven't seen any really going over the 100%, but that figure is about to change. Excuse me, if this number keeps going down, because this is days on market that's going down really significantly. So look at that. I mean, that is a drop. Hopefully we're not going to get to the 26 days or less, because that is that insanely hot market. So hopefully it's just going to settle down. But seller's market, we are in a seller's market. And this just gives you an idea. And Stephen Thomas's prediction is that we're going to go down, and we're going to be back in that hot seller's market. And well, the seller's market, I'm not going to say a hot seller's market because we don't want to be down here, but we're going to be in a seller's market, and we're going to stay there for the duration, because we don't have enough inventory. There just isn't enough out there for the demand for the buyers that we have. Looking specifically at some of our cities in the area, so Dana Point, our median list price, so this is of properties that are, on the market currently, is 3.3 million. The price of new listings is almost 5 million. So those are very high priced properties right now. Our median days on market is 84. So those, because of the higher price point, those are going to take a little longer. We're still seeing the 41% are seeing price reductions. So that's higher than the national average. We're starting to see some of the properties be relisted, and only 37 properties on the market. That is just crazy for Dana Point. That's why we're in a slight seller's market, because we don't have enough inventory. There isn't enough out there for our buyers. Second one is San Clemente, and our median list price is just under 2 million. The price of new listings is 1.5. This is going to open up opportunities for more buyers than Dana Point has to offer. Our median days on market, 91. We should see that dropping. And price decreases, we're still seeing those overpriced properties having to see a decrease. And it's some of the luxury properties, because the luxury market has slowed down a lot faster than our sort of median market. Inventory is 57. Again, unbelievably low number for our environment, for what we saw pre-COVID. San Juan Capistrano, we are seeing, and you know what? I think I missed one. Oh, Laguna Beach. That's what I missed. So Laguna Beach, sorry, let's do Laguna Beach quickly. This is our highest priced community in the area. Median list price is just under 4 million. New listings coming on are actually closer to 4.5 million. Average days on market is going to be 133, but we're even starting to see a little tiny drop off in that. And these are those luxury, higher end luxury properties. Price decreases are slowing down, and there's 71 properties on the market. Not a lot. We've done San Clemente, and let's do San Juan Capistrano. Median list price 2 million. New listings are coming on at 1.6, 1.7 million. Average days on market 63. San Juan Capistrano continues to be our fastest paced market in the 4 cities that we really demonstrate here. Price decreases, again, those higher end properties. We have some very high end properties in San Juan Capistrano are having to go through a couple of price reductions, and our inventory is 34. So a strong seller's market. So are more properties coming onto the market? Yes, ever so slightly, but they just aren't enough properties for the buyer demand. And I know I've shown this for the past couple of weeks, but I think this is a really, really good reminder. It still applies. So if you are a seller and you're waiting for a quick sale and a higher price than the last comparable sale and really looking back too far, that's just not going to happen. So come onto the market where the true market value is, price ahead of the market. Yes, inventory is low, but your buyers are also a little savvier than they were in those desperate times. And actually some of those buyers are having buyer's remorse right now because they had to throw so much money just to get into a home. Today's buyers are definitely, they're going to take a little longer, not much, than the 26 days. But if your property is priced correctly for location and condition, again, location and condition in today's market, then that is going to result in a great sale for you. Buyers, there are no bargains coming. The market is not crashing. In fact, you are starting to enter in and prepare for our spring market where multiple offers are going to be the norm for properties that are priced correctly for condition and location. So be prepared. Sellers and buyers, you're going to have to be flexible when it comes to contingencies. Buyers, depending on how attractive their prices, their list prices, you may have to waive some of your contingencies. Sellers, you may have to consider allowing some. So it's getting closer to a better win-win situation for buyers and sellers, but without a doubt, because of the lack of inventory, sellers who are entering the market now have the upper hand so long as you're reasonable, and your property will sell. As always, our team, we are real estate planners, and it's so much more than just putting a sign in the yard. We, are passionate about helping families build and transfer wealth through real estate. And we have a number of tools to help you with that. Obviously, we will help you with a current portfolio analysis. We were working on one of those this morning to see if an investment property is truly performing. And we're going to definitely expose you to opportunities in other parts of the country. I mean, we were chatting, there were a couple of agents on a Zoom call this morning. Do you realize that there are cap rates of 14% available in other parts of the country? And when you look at those price tags for those properties, they're pretty attractive compared to if we find a 4% cap rate in Southern California. We're pretty excited about that. We're going to look twice at that. So we're here to help you with those opportunities, to help you grow your wealth. A very important one that we will assist you with and guide you through is generational wealth building, and our favorite, the family feud prevention plan. If you are building a portfolio to leave for your beneficiaries, please keep in mind that a house cannot be equally divided when your beneficiaries are not in agreement with what has to happen to their property once they receive it as their gift from you. And you could be leaving them a legacy of a lawsuit rather than the enjoyment of the benefits of all your hard work. So we would love to be of assistance to you. And this is how you can get hold of us. If you have any questions, would like an asset performance analysis done on any of your properties, would like to know what the market value is of your home. And this is a comparative market analysis. It's not a true valuation. We are not authorized to do valuations. Only an appraiser can do that. But we could definitely give you an idea of how your property compares to others on the market. Please reach out. We are here to serve you. And with that, I am going to stop talking because I'm about to lose my voice, and I will see you next week.